Hi there. Today we're exposing why Section 24 could cut your mortgage interest relief to zero in 2026. If you're a UK landlord, this update is essential. Don't miss it.
Hello there. This entire breakdown comes straight from the expert tax advisors at Pro Tax Accountant, one of the UK's most trusted accounting firms. We're going to get right into a massive issue for landlords today, the Section 24 crisis. And specifically, we're going to tackle the very real possibility that your mortgage interest relief could completely vanish.
So let's kick things off with a question that, well, it just sounds wrong, doesn't it? Is it actually possible for your rental property to be putting cash in your bank account every single month, but for you to still end up with a net loss once the taxman has had his say? It seems crazy, but for more and more UK landlords, this is the brutal reality they're now up against.
Let's make this real. Imagine Fred from Manchester. His properties bring in a real, tangible cash profit of £5,000 a year. You'd think that's good news, right? Not so fast. When his tax is calculated under the new rules, his final bill is £6,000. You heard that right. His tax bill is £1,000 more than his actual profit. This catches so many people out. So how on earth is this even possible?
To get our heads around Fred's situation, we have to go right to the heart of the problem. It all stems from a huge change to the tax system called Section 24. And what it did was completely flip the script for landlords. The short version is this: you're no longer taxed on your profit, you're now being taxed on your turnover. You see, before 2017, everything was pretty straightforward. As you can see there in the old rolls column, you take your rent, you deduct all your costs, including your mortgage interest, and you pay tax on what was left. Simple. But now, under Section 24, you cannot deduct your mortgage interest anymore. Your taxable income is now your total rent, minus only things like maintenance. And what this does is artificially pump up your income, at least on paper.
And this is where things get really dangerous. As this quote from National Property Buyers says, this one change can shove you into a higher tax bracket, even if your real profit hasn't gone up by a single penny. It's also why some people started calling Section 24 the tenant tax, because landlords felt they had no choice but to put rents up just to cover this massive new tax burden. I can hear you thinking, but hang on a minute, don't I get a 20% tax credit on my mortgage interest to balance this all out? Well, yes and no. And that brings us to the next part of this crisis, what I like to call the 20% illusion. Because that tax credit, it's really not the safety net that so many landlords think it is. You'll definitely want to hear this part. The biggest, and honestly, the most dangerous assumption people make is that they are guaranteed a 20% credit on every single pound of mortgage interest they pay. That is absolutely not true. The reality is much, much more complicated. And believing this myth can lead to a really horrible shock when that tax bill lands on your doormat. Right, this is the crucial bit. The tax credit is governed by something called the lower of rule. All this means is your tax relief is worked out as 20% of the smallest of three very specific numbers. It is not a simple 20% of your total interest costs. Getting your head around this is absolutely vital. Okay, let's break this down. HMRC looks at three different figures. First, your total finance costs for the year, so your mortgage interest. Second, your property business profits. That's your rental income after you take away your allowable expenses. And third, your adjusted total income. Your tax credit is simply 20% of whichever one of those three numbers is the lowest. That's it. This table shows you exactly how that plays out. Look at that top line. In a good year with high profit, your finance costs are the lowest number, so you get 20% of that. Fair enough. But now look at the second row. If your profit is low, maybe because of a quiet period, that becomes the cap. Your credit is only 20% of that £2,000 profit, not your $12,000 in interest costs. And here is the absolute killer, right at the bottom. Say a big repair bill, like a new boiler, wipes out your profit and you make a loss. Well, your property profit is now zero. The lowest of the three figures is zero, and 20% of zero is, well, it's zero. Your tax relief is completely gone. And believe it or not, it doesn't even stop there. This whole problem is being squeezed from every angle by other economic pressures, and it's creating a perfect storm for landlords. We're in the middle of what you can only call the great tax squeeze.
So the first part of this squeeze is something called fiscal drag. What that means is the government has frozen the income tax thresholds all the way through to 2031. The goalposts for basic and higher rate tax aren't moving. But at the exact same time, Section 24 is making your on-paper income look bigger. So even if your real profit doesn't change, you're silently being dragged into higher tax bands.
Let's go back to our friend Fred for a second. With his day job and his real rental profit, his income was a comfortable £40,000, putting him in the basic rate band. But fast forward to 2026, and because his mortgage interest isn't being deducted anymore, his taxable income on paper has jumped to $55,000. He hasn't actually earned a single penny more, but now he's a higher rate taxpayer, and his tax bill is about to go through the roof.
And here's a pro tip from our experts, because the knock-on effects of this are really severe. This inflated paper income can easily push you over the £100,000 threshold, which is where you start losing your tax-free personal allowance. It can also tip you over the £60,000 limit, and that means HMRC can start clawing back your child benefit. And if you decide to sell a property, it can shove your capital gains into the much higher 24% tax band. These are the hidden traps that so many landlords are falling into.
The other side of the squeeze is just plain old rising costs. Landlords are now facing mandatory spending to get their properties up to a certain energy efficiency rating. And on top of that, you've got the extra admin and potential software costs that come with making tax digital. So it's a proper double whammy: higher tax bills on one side and higher expenses on the other. So if you think the situation is tough right now, you really need to be aware of what's already been legislated to happen next, because if all these pressures weren't enough, there are even more changes already lined up. Stay with me. This next point affects every single landlord in the country.
This timeline lays it all out. From April 2026, dividend tax rates are going up, and that's a big deal if you run your portfolio through a limited company. Then a new energy model for EPCs is coming, which could actually make it harder to get that C rating. But the really big one is April 2027, brand new higher tax rates designed specifically for property income. And all of this is leading up to that final EPC deadline in 2030.
Let's be crystal clear about this, because it's a major shift in policy. The government is creating a separate tax system just for property income, and the rates are higher across the board. The new basic rate will be 22%, the higher rate will be 42%, and the additional rate 47%. What this means is your rental profits are about to be taxed more heavily than almost any other type of income you can earn. Okay, that was a lot of pretty grim news, I know, but the point of this isn't to scare you, it's to prepare you. Now that we really understand the size of the challenge, we can start talking about strategy. What are the proactive steps that you can, and probably should, be thinking about right now? So here are the key responses. First, you absolutely have to do a full, honest review of your portfolio's real profitability. Second, if you can, paying down mortgage debt is a great move, because that reduces the finance costs that are at the root of this whole problem. For some, that might even mean selling properties that are heavily mortgaged but don't bring in much rent. And of course, many are looking at incorporating. But honestly, the most crucial step of all is the one at the bottom. Get expert, bespoke tax advice that's tailored to you. Let's just quickly touch on incorporation, because it's the strategy everyone's talking about. The good points are obvious. Companies aren't affected by Section 24, so they can deduct 100% of their mortgage interest. But it is not a silver bullet. You could get hit with a big capital gains tax bill just for moving the properties into the company. Mortgages are often more expensive for companies, and as we just saw, the tax on dividends you pay yourself is also going up. It's a decision that needs very, very careful sums. And that really brings us to the final critical question you have to ask yourself. With everything we've talked about, the tax on turnover, the vanishing tax relief, the fiscal drag, and the new taxes hurtling down the tracks, is the way you currently own and manage your properties still fit for purpose? For a lot of landlords, the honest answer is probably going to be no. Right, before we wrap up, it is absolutely essential that I make this clear. The information we've gone through today is for general guidance. It is not a substitute for professional advice that's tailored to your unique financial circumstances. You should always consult an expert before you take any action. The entire landscape for landlords has permanently changed. To get back in control, you need a proper strategy that's based on expert knowledge. We really do encourage you to get in touch with the specialists at Pro Tax Accountant for a consultation. You can reach them on the WhatsApp, phone, or email that's on your screen now. And please do subscribe to the channel for more essential updates just like this one. Thanks for watching.